Hi, I wanted to give you a slightly longer explanation of the first Essential Question 1 quiz. This is the one that has to do with accounting ratios. And so let's talk through some of the issues, and hopefully this will help you on with the other ones. Now, this started off with item number 1, which is purchase of new equipment for your bicycle repair shop using cash. The idea is each one of these transactions is going to have an echo that takes place in many of the different documents, and you've got to maintain the accounting principles throughout. Purchasing the new equipment for cash means that you're trying to get yourself a nice fixed asset, which is one kind of asset, so fixed assets are supposed to increase. And then what you're going to see is a decrease in the current assets. And so the assets themselves are going to balance each other out. And you've got to remember your balance sheet is always supposed to be balanced. Assets plus is supposed to be equal to liabilities plus owner equity. And so it already balanced it out on the balance sheet. Now, because you're purchasing a piece of equipment, you notice that one of the items was cash. You have to take into account that the cash is flowing in and out. That's something that happens on the cash flow statement. So the cash flow statement should show that there was a release of cash going out. So you're looking at a negative number over there. Cash decreasing in the section that's there on investments. Investments is a section on the cash flow statement for purchase and sale of assets. So that should be pretty clear on the first one. You're supposed to have an increase in fixed assets, a decrease in current assets, and then cash from investments should actually go down. The second one, business is booming, so you hired an assistant. Of course, a lot of these are subject to interpretation, but the core of this is that you're actually increasing your expenses per month. That assistant is going to cost you so much per month, and that per month part tells you you're dealing with one of the statements, which is a flow. So in this case, what you're looking at is kind of expense, and you're going to see expenses go up, and then what you're seeing is that it'll bring itself down to the bottom of the income statement, and you're going to see a decrease in net income. So the part you're seeing there is just on the income statement. The income statement flows over into the cash flow statement into cash from operations. A decrease in net income means that you're going to see a decrease in cash from operations, and that's going to lower your net cash flow. So that's the combination that's there on that one. Now what we have here is the next one is business has gotten too large to operate out of the garage, so you rent a small commercial space. It's almost the exact same question as what you had before. All that you're doing is saying, I have this additional expense, and the answer is virtually the same as the last one. That's one of the things you'll notice about these questions. There are only about 8 different basic transactions, and all you're doing is identifying what kind of transaction it is and then filling in the blanks. Question number 4. A loyal customer needs her bicycle repaired again but cannot pay right now. She promises to pay you when she gets her paycheck in a week. So you could start talking about sales, but the core of this particular one, and there's always some flexibility, is that you're acquiring an asset, and that asset is supposed to be an accounts receivable. And again, this has to be balanced off, which means that there was no other change in any other asset, there's no other change in liability. So the only thing that should be changing then is that there's an increase in owner equity to go ahead and balance it off. And so you got your balance sheet balanced. Did you see any cash go in and out? Not really. But if you complicate yourself a little bit from the cash from operations side, perhaps you can go ahead and do it there, but really there's no exchange of cash just yet. Due to a large increase in fuel prices, you gain 10 new customers who sell their cars and become full-time bicyclists. Again, this is supposed to be this bicycle shop. What you have here is a sale. You have an increase in revenue. Increase in revenue means if you drift on down, that's on the income statement, you'll see net income increase. An increase in net income carries over to the cash flow statement, and you're going to see an increase in cash from operations. So you've got a couple of them that have been at higher expenses. This one is supposed to be a higher revenue. The next item is 6, which could be a little bit complicated, which is Grandma donates her old Ford pickup to the company to use as a company car. Now the truck clearly represents an asset, and so you're going to see an increase in those fixed assets. That's the truck. But again, the balance sheet must also balance. So this thing actually has value, and what it represents then is supposedly an increase in owner equity that's there. So you got it on a good deal, and so your owner equity is going to increase too. Now that your balance sheet's balanced, did you notice there was no cash that was moving through there? That's right. So there's no echo on the cash flow statement. Generally speaking, the cash flow statement only gets an echo when there is going to be cash in one part of the transaction. So just watch for the cash, and you know when you're supposed to have something happen on the cash flow statement. 7, you open a new line of credit to purchase 5 new bicycles that you plan to rent out. So what you're doing here is that you're borrowing money, so clearly you've got a liability, And you are also going ahead and purchasing new assets that you're going to hold on to. And these are fixed assets. These aren't part of your inventory. So what you see is an increase in fixed assets, which are balanced out by an increase in liabilities, and now your balance sheet balances again, which is what's supposed to happen. Now, you pulled out a line of credit, so there's no net change in cash, but what you have is actually a sink and a source of cash at the same time. This is one of those complicated transactions. The sink for cash is the purchase of the bicycles, and so cash is flowing out when you purchase the bicycles. But there's also a source of cash within the finance section because you're taking out that line of credit, the loan. And so those two net each other out, so you're not going to see any change in net cash. So this is the complicated one. You have an increase in assets, increase in liabilities, decrease in cash from investments, and an increase in cash from finance. Perfect. The last one is your shop gets broken into in the middle of the night and your entire stock of rental bikes is stolen. All right. Now, you could have some kind of expense that's going on right there, and that's like the advanced answer. But you're also really looking at is a decrease in your fixed assets that are hiding there. And so what you see is a decrease in assets, balanced off by, of course, a decrease in owner equity. No cash has changed hands. And that's the easiest answer there. Again, the advanced answer is to say, oh, there's these expense here because you have a loss of this particular capital, and that's going to be a kind of extraordinary expenses there. I hope this helps you out with question number 1, and I may do some more of these later.